are the headlines. This is Democracy Now!, democracynow.org, the War and Peace Report. I'm Amy Goodman with Sharif Abdel-Qaddous.
And welcome, everyone. President Obama visited Wall Street Monday to promote a regulatory overhaul of the U.S. financial system. The visit came on the one-year anniversary of the collapse of the investment bank Lehman Brothers. Lehman's bankruptcy set off a series of events across the financial markets, leading to a full-scale economic meltdown. Speaking at Federal Hall, Obama touted the federal government response in the years since, including the massive Wall Street bailout. He also promoted Democratic proposals for new financial oversight and a consumer protection agency to protect Americans from unfair loans. In some of his most pointed criticism of Wall Street to date, Obama said reckless behavior and unchecked excess was at the heart of the crisis.
While full recovery of the financial system will take a great deal more time and work, the growing stability resulting from these interventions means we're beginning to return to normalcy. But here's what I want to emphasize today. Normalcy cannot lead to complacency. Unfortunately, there are some in the financial industry who are misreading this moment. Instead of learning the lessons of Lehman and the crisis from which we're still recovering, they're choosing to ignore those lessons. I'm convinced they do so not just at their own peril, but at our nation's. So I want everybody here to hear my words. We will not go back to the days of reckless behavior and unchecked excess that was at the heart of this crisis, where too many were motivated only by the appetite for quick kills and bloated bonuses. Those on Wall Street cannot resume taking risks without regard for consequences and expect that next time American taxpayers will be there to break their fall. And that's why we need strong rules of the road to guard against the kind of systemic risks that we've seen. And we have a responsibility to write and enforce these rules to protect consumers of financial products, to protect taxpayers, and to protect our economy as a whole. Yes, these rules must be developed in a way that doesn't stifle innovation and enterprise. And I want to say very clearly here today, we want to work with the financial industry to achieve that end. But the old ways that led to this crisis cannot stand. And to the extent that some have so readily returned to them, underscores the need for change and change now. History cannot be allowed to repeat itself.
Although Obama had harsh words for Wall Street, he took a softer line in asking for a series of voluntary changes, including overhauling pay structures and subjecting bonuses to a shareholder vote.
Here on Wall Street, you have a responsibility. The reforms I've laid out will pass, and these changes will become law. But one of the most important ways to rebuild the system stronger than it was before is to rebuild trust stronger than before. And you don't have to wait for a new law to do that. You don't have to wait to use plain language in your dealings with consumers. You don't have to wait for legislation to put the 2009 bonuses of your senior executives up for a shareholder vote. You don't have to wait for a law to overhaul your pay system so that folks are rewarded for long-term performance instead of short-term gains. The fact is, many of the firms that are now returning to prosperity owe a debt to the American people. They were not the cause of this crisis. And yet American taxpayers, through their government, had to take extraordinary action to stabilize the financial industry. They shouldered the burden of the bailout, and they are still bearing the burden of the fallout in lost jobs and lost homes and lost opportunities. It is neither right nor responsible, after you've recovered, with the help of your government, to shirk your obligation to the goal of wider recovery, a more stable system, and a more broadly shared prosperity. So I want to urge you to demonstrate that you take this obligation to heart, to put greater effort into helping families who need their mortgages modified under my administration's home ownership plan, to help small business owners who desperately need loans and who are bearing the brunt of the decline in available credit, to help communities that would benefit from the financing you could provide or the community development institutions you could support, to come up with creative approaches to improve financial education and to bring banking to those who live and work entirely outside of the banking system. And, of course, to embrace serious financial reform, not resist it.
For more on Obama's speech and the 1 year since the outbreak of the financial collapse, we are joined by Nomi Prins. She is a former investment banker who worked at Goldman Sachs and Bear Stearns, now a journalist and author of several books, including her latest, just out, It Takes a Pillage, Behind the Bonuses, Bailouts, and Backroom Deals from Washington to Wall Street. Her latest article posted on the Mother Jones website is called Obama Banking Too Much on Banks. She joins us from Los Angeles today. Welcome to Democracy Now, Nomi. Well, let's start with that title, Why Banking Too Much on Banks?
Well, most of what Obama was saying to the Wall Street leaders who were in that room was kind of help us do what we need to do. You know, you cut down your bonuses, you take care of helping homeowners renegotiate their mortgages, kind of, we're not going to make you do it. We will probably pass few reforms that will do something to that effect. But, you know, could you guys help us out, restrain you? And just that very notion. And the notion that because Wall Street is healthier than it was last year, after receiving something like $17.5 billion worth of guarantees, of cheap loans, of other kinds of subsidies, of backup for in case they lose money again, the fact that they've returned to some kind of health and normalcy, as Obama put it, rather than looking at what Main Street is actually going through and how it has declined in terms of its own economic health, really just places the emphasis on the wrong group of people.
And what about the issue of these big banks becoming even bigger? Part of the reason for the bailout was we were told they were too big to fail. If they failed, it would cause a systemic collapse of the financial system. Now, a year later after this, many of these big banks are even bigger. And if the risk-taking isn't left unchecked, doesn't that set us up for a bigger fall?
Absolutely. This time the bigger fall will have been federally funded and federally invoked because, yes, for one thing, the bigger banks are bigger. J.P. Morgan Chase was given Bear Stearns and Washington Mutual with some padding from the U.S. government in terms of guaranteeing additional losses that it might incur from acquiring those companies. It became bigger. Wells Fargo, Wachovia became bigger. Wachovia was run for a little bit by a former Goldman executive. It became bigger under a Fed and Treasury decision, although it's ultimately the Fed's decision to push mergers. Bank of America Merrill Lynch, bigger. That is a risky, risky institution. Merrill Lynch was on the brink of failure. It was about to become a Lehman Brothers, and the choice was to give it to Bank of America and make the combined entity bigger. So now we have three banks that actually push outside of the 10% limit laws that the FDIC is supposed to enforce and has in place to restrict the amount of deposits, consumer deposits they can hold. They are all at or above the limits, and they were put there by the federal government.
And what about the issue of Wall Street compensation? We saw earlier this year an uproar over the bonuses at AIG. Goldman Sachs this year is on track, on average, per employee to earn $700,000 on average. It does not seem that compensation has been curtailed at all.
No, in fact, compensation is actually running ahead of what it was in 2007. So not only has it not been curtailed at a place like Goldman Sachs, it's actually on track to be more than it was before the crisis. So the idea that there's going to be any sort of constraint or restraint coming from inside the meeting rooms where bonuses are fought for and discussed really every day of the year after every big trade that happens is just ludicrous.
Just following up on that point, a headline that we just read about the bank, the court that challenged the bonuses. Can you talk about the significance of that?
Well, I'm actually really glad you brought up that point because I thought it was insane that the SEC agreed to a $33.5 million settlement on a $3.6 billion bonus misrepresentation when the federal government backed the acquisition of Merrill Lynch by Bank of America at the end of last year that took effect on January of this year. The fact that there was even a settlement to begin with so quick and so cheap was absolutely insane. So Judge Rakoff absolutely did the right thing to say, wait a minute, this is not moral, this isn't just, this isn't right. We've paid money to have that merger